Now, the Aussie dollar actually went back above 80 US cents last night, but when the sun rose this morning, it was sinking. It went under 79 about 8 a.m, stayed there till lunchtime and then started falling again this afternoon. And it wasn't even helped by a better than expected quarterly terms of trade, down less than 1% versus an expected fall of 2.4%. The terms of trade, which is the ratio of export prices to import prices, have now fallen 25%. And the main consequence of that is on display in this chart. National income is now falling, even as GDP is rising. The reverse happened when the terms of trade were rising, which you can see after about 2002 on the graph. Income rose much faster than output then. But now income is falling. And the problem is we measure economic success through GDP alone. A recession happens when GDP falls for 2 quarters in a row. But if income falls and GDP doesn't, it can feel like a recession even though the statisticians and the economists tell us it isn't one. And by the way, the Australian dollar is down, but the New Zealand dollar is down much more. That's because the price of its main commodity, milk, is down more than our main commodity, iron ore. And the Kiwi Reserve Bank is more gloomy than ours, at least till next Tuesday. And something momentous happened today. The 10-year government bond rate fell below the cash rate. So now you get less for lending the government money for 10 years than for one night. Hardly a good deal. The result is that the hunt for yield by investors is back on in earnest, so that Commonwealth Bank hit a new record high today, and that plus AMP and Fortescue getting some bargain hunting attention took the local share market higher, despite another big fall in New York last night. And the Athens share index dropped nearly 10%, which means it's fallen by half in less than 12 months. And that's finance.